welcome to the deep dive. If you're exploring ways to add some diversification to your retirement nest egg, Gold IRAs often come up.
They certainly do.
But the real key, the part that can save you a lot of headaches down the road, is really understanding the tax implications when it's time to actually, access those precious metals.
Absolutely. It's one thing to build that retirement savings and quite another to ensure you can use it efficiently without, well, unexpected tax bills taking a big bite.
Right.
We often see people focus intently on the initial investment, and while that's important, knowing the distribution rules is where long-term financial success really lies.
Right. So today, we're laser focused on giving you that clarity. You're looking for the essential knowledge without the fluff to understand how taking distributions from a Gold IRA is taxed. Think of this as your shortcut to avoiding potential pitfalls and, well, making informed decisions. And to guide us through this, we have insights from Doug Young, a financial investing professional with over 20 years of deep experience in precious metals and retirement planning.
A great resource.
Okay, let's dive right in. Why is getting a handle on these distribution taxes just so crucial?
Well, at its core, it's about keeping more of your own money, right?
Sure.
The IRS has a specific set of rules governing how and when you can take distributions from a Gold IRA. Not understanding these rules can lead to some pretty significant penalties.
Penalties, okay.
Which can really eat into your retirement savings.
And nobody wants to see that happen after years of hard work and saving.
Exactly.
So it's not just about the potential growth of the gold itself, but about navigating the tax landscape effectively when you actually need to use those funds.
That's it.
It sounds like smart planning around withdrawals can make a real difference in minimizing your tax liability.
Precisely. By thinking ahead about when and how you take distributions, considering your, overall financial picture in retirement, you can strategically reduce the amount you owe in taxes. It's about playing the long game.
Okay, let's talk about some key milestones then. What's an important age we should have on our radar when it comes to Gold IRA distributions?
The really significant one to be aware of, especially now, is age 73.
73, okay.
Starting in 2024, that's the age when required minimum distributions, or RMDs, must begin from your Gold IRA.
RMDs, right.
Think of it as the IRS saying, okay, you've had the tax benefits, now it's time to start taking withdrawals.
73. Got it. So what happens if you, for whatever reason, don't start taking those RMDs when you turn 73? What kind of consequences are we looking at?
Yeah, the IRS takes this pretty seriously. If you fail to take your required minimum distribution on time, you could face a penalty of 25%.
Wow, 25.
Of the amount that should have been withdrawn. Now, there is a bit of a safety net, thankfully.
Okay.
If you catch the mistake and correct it within 2 years, that penalty can be reduced to 10%.
10% is still quite a bit, though.
Oh, it's still a hefty chunk, yeah. So it's definitely best to stay on top of those RMDs.
Absolutely. 25% is a serious hit. Knowing that 73 is the trigger for RMDs is definitely a key piece of the puzzle. Now, when it comes to Gold IRAs, are there different types? And do those types have different tax implications when you start taking distributions?
Yes, absolutely. There are two primary types, traditional Gold IRAs and Roth Gold IRAs.
Okay.
And the way they're taxed, both on the way in and, more importantly for our discussion today, on the way out, is quite different.
Okay, let's start by breaking down traditional Gold IRAs. What's the tax situation with those when it comes to taking distributions?
So with the traditional Gold IRA, the money you contribute is typically pre-tax.
Pre-tax, right.
This means you often get a tax deduction in the year you make the contribution, which, can be a nice immediate benefit. However, when you start taking distributions in retirement, those withdrawals are taxed as ordinary income, just like your salary or wages would be.
So you get a tax break up front, but you'll pay taxes on those funds when you withdraw them later. Can you give us a quick, clear example of how that works?
Sure. Let's say, imagine you take a $10,000 distribution from your traditional Gold IRA in retirement.
Okay.
That entire $10,000 will be added to your taxable income for that year, and you'll pay taxes on it at your applicable income tax rate.
Got it.
As Doug Young points out, traditional Gold IRAs offer a tax break up front, but you'll pay taxes on distributions. It's just a matter of when you pay the tax, man.
That makes perfect sense. taxed as regular income during retirement.
Yeah.
Now, let's switch gears to Roth Gold IRAs. I know the initial funding is handled differently.
Exact.
How does that impact the tax picture when you take distributions?
Right. So Roth Gold IRAs are funded with money you've already paid taxes on after-tax dollars.
After tax.
You don't get a tax deduction when you contribute. But here's the potentially big advantage. If you've held the account for at least 5 years, Andy, you're over 59 and a half years old when you take distributions.
The 5-year rule in 59 and a half.
Then those withdrawals are generally completely tax-free.
Wow, tax-free withdrawals in retirement. That sounds like a significant benefit.
It really can be.
So as long as you meet those two conditions, the 5-year holding period and being over 59 and a half filled, you're generally in the clear when you take money out.
That's generally the case for what they call qualified distributions. For example, if you opened a Roth Gold IRA, say, 6 years ago, and you're now 68, any qualified withdrawals you make would typically be tax-free at the federal level. This can be a huge advantage in managing your tax burden in retirement.
Yeah, I could see that.
That's income you don't have to factor into your tax calculations.
Okay, so we've covered the two main types of accounts and how their distributions are generally taxed. Now let's dig a bit deeper into how the type of distribution itself can affect taxation. We've talked about RMDs. What other kinds of distributions might someone take from a Gold IRA?
Well, we also have early withdrawals, which are taken before you reach age 59 and a half.
Okay, the early ones?
And standard withdrawals, which typically occur between age 59 and a half and when you're required to start taking RMDs, which is currently age 73.
Gotcha. Let's circle back to those required minimum distributions for a moment, just to make sure we're completely clear. These kick in at age 73.
Correct.
And are taxed how?
They are taxed as ordinary income, just like withdrawals from a traditional Gold IRA.
Okay.
And as we discussed, failing to take them can result in that 25% penalty on the amount you should have withdrawn.
Right, the big penalty.
To illustrate the potential cost, I mean, if your RMD was, say, $5,000 and you missed it entirely, you could be looking at a $1,250 penalty. Or $500 if you managed to rectify the situation within 2 years. It really underscores the importance of planning for and taking those RMDs.
Definitely a costly oversight to avoid. Now, what about those early withdrawals? What are the tax implications if someone needs to access their Gold IRA funds before that 59 and a half mark?
Right. Taking money out of your Gold IRA early, so before age 59 and a half, comes with a significant tax consequence.
Okay.
Not only will you owe regular income tax on the amount you withdraw, but you'll also likely be hit with an additional 10% early withdrawal penalty.
10% on top of the income tax?
Yes. It's like an extra fee for accessing those retirement funds prematurely.
Can you walk us through a quick example of how that 10% penalty works in real numbers?
Certainly. Let's say you withdraw $10,000 from your Gold IRA when you're maybe 50 years old.
Okay.
You'll have to include that $10,000 as part of your taxable income for the year. And on top of that, you'll owe a $1,000 penalty that's 10% of the $10,000 withdrawal.
So it's a double tax whammy. They can really take a bite out of your withdrawal.
It absolutely can.
Okay, so definitely a strong disincentive to tap into those funds early unless it's, absolutely necessary.
Yeah, right.
Now, what about those standard withdrawals, the ones taken between age 59 and a half and 72?
These are more straightforward from a penalty perspective. Standard withdrawals taken during this age range from a traditional Gold IRA are taxed as ordinary income.
Just like the RMDs?
Exactly, just like RMDs and other post-59 and a half distributions from a traditional IRA. The key difference here is that you avoid that extra 10% early withdrawal penalty. So, for instance, if you withdraw $15,000 at age 65 from a traditional Gold IRA, that $15,000 is simply added to your taxable income for the year.
And for a Roth?
For a Roth Gold IRA, assuming you've met that 5-year holding period, those withdrawals would still generally be tax-free.
Okay, so the age at which you take a distribution clearly has a major impact on how it's taxed and whether you'll face penalties. Let's try to summarize those age-based rules just to keep it clear.
Good idea. So if you're below age 59 and a half,
under 59 and a half,
generally expect to pay income tax on any distributions, plus that additional 10% early withdrawal penalty. Now, I should mention there are some specific exceptions to that penalty, such as in cases of qualified disability or for certain unreimbursed medical expenses, but those are pretty specific situations you'd need to look into carefully.
Okay, good to know there are potential exceptions. And then what about the window between 59 and a half and 72?
Right. In that time frame, withdrawals from a traditional Gold IRA are taxed as ordinary income, but the good news is that 10% early withdrawal penalty no longer applies.
No penalty.
Okay. And for a Roth Gold IRA that meets the holding period, withdrawals generally remain tax-free.
And then, as we've discussed, after age 72, really starting at 73 now,
Yeah, starting at 73.
it's all about those required minimum distributions, which, from a traditional Gold IRA, are taxed as ordinary income. And again, failing to take those triggers that significant 25% penalty.
Exactly. Understanding these age-related milestones and the associated tax implications is really fundamental to effectively managing your Gold IRA.
Now, it's not just about when you take the gold out, is it? I understand there are also rules about what you can and can't do with the gold while it's still inside the IRA.
Oh, yes.
Let's touch on these prohibited transactions.
This is a crucial area to be aware of. The IRS has strict rules against you using the physical gold held within your IRA for any personal benefit before you reach the permissible age for distributions.
So you can't borrow it.
No. And the gold must be held in a qualified IRS-approved depository. You can't, for example, take possession of the gold bars or coins and store them in your own home safe.
So no admiring your gold eagles on your mantelpiece before you're of age.
Precisely. That would be considered a prohibited transaction and a violation of IRS regulations.
And what's the penalty for that?
The penalty for engaging in such a transaction is quite significant. A 15% tax on the amount of the transaction.
15%, wow.
And this is in addition to any other potential taxes or penalties that might apply. As Doug Young emphasizes, using the gold in your IRA for personal use before attaining the distribution age is a violation of IRS laws.
Right.
The IRS really wants to ensure the gold remains intended strictly for retirement savings.
15% is another substantial penalty to steer clear of. So the key takeaway there is that the gold must remain in that approved facility until you take a proper distribution.
Correct. Locked away safely.
Okay, so we've covered the tax implications, the penalties for early withdrawal and failing to take RMDs, and these prohibited transactions.
Yeah.
Now let's shift our focus a bit to strategies. Are there any proactive steps someone can take to potentially minimize the tax impact of their Gold IRA distributions?
Yes, there are several strategies worth considering. One key aspect is the optimal timing of your withdrawals.
Timing, okay.
If you anticipate being in a lower income tax bracket in certain years during your retirement, it might make sense to take larger distributions in those years.
Ah, to keep it in the lower bracket.
Exactly.
Well,
Potentially keeping you within that lower bracket and reducing your overall tax liability. Similarly, spreading your withdrawals out over multiple years could help prevent you from jumping into a higher tax bracket in any single year.
that's a smart approach, trying to sort of smooth out your taxable income in retirement rather than having big spikes.
It requires some planning.
What other strategies might be beneficial?
Well, we've already highlighted the potential tax advantages of using a Roth Gold IRA.
The tax-free withdrawals.
Right. If you contribute to a Roth, those qualified distributions in retirement are entirely tax-free, which can be a really powerful way to control your tax burden in the long run, especially if you think your tax rate might be higher in retirement than it is now.
Good point.
It's a form of tax diversification for your retirement income, really.
Definitely a compelling reason to consider a Roth option if it aligns with your financial circumstances and expectations. Are there any other proactive steps?
I'd say seeking personalized advice from a qualified tax professional is always a good strategy.
Talking to an expert.
Yeah. A tax advisor can help you understand your specific financial situation, develop a tailored withdrawal strategy that minimizes your tax liability, and just ensure you're in full compliance with all the current IRS regulations.
Which can change.
Exactly. They can also help you navigate any potential exceptions or nuances that might apply specifically to your case.
So getting that expert individualized guidance can be really valuable in navigating these sometimes complex rules.
Absolutely essential for many people.
What about the initial contributions to a Gold IRA? Can those offer any tax benefits that might indirectly have an impact down the line at the distribution phase?
Yes, definitely. For traditional Gold IRAs, as we discussed, your contributions are typically tax deductible in the year they're made.
The upfront break.
Right. This can lower your taxable income in the present, effectively providing a tax benefit up front that sort of balances out the taxation on distributions later.
Okay.
Additionally, some individuals may be eligible for tax credits, like the Saver's Credit for contributions to retirement accounts, including Gold IRAs, which can provide further tax advantages.
Ah, the Saver's Credit.
While these don't directly change how distributions are taxed, they are important overall tax benefits related to your retirement savings picture.
Great points. So it's not just about the money coming out, but also about the tax advantages on the way in and the overall tax planning around your retirement savings.
It's the whole life cycle of the account.
Now, just to quickly recap some of the most important things we've covered, let's maybe touch on some frequently asked questions. What are the key tax implications, again, if someone takes an early withdrawal from their Gold IRA?
Okay, so if you withdraw funds from your Gold IRA before reaching age 59 and a half, you'll generally incur that 10% penalty on the amount withdrawn, in addition to having that withdrawal taxed as ordinary income.
Got it. And how does your age at the time of distribution generally affect how those distributions are taxed? Sort of the quick summary.
Sure. So below age 59 and a half, you're typically looking at the 10% penalty plus income tax.
Okay.
Between 59 and a half and 72, distributions from a traditional Gold IRA are taxed as ordinary income, but without that early withdrawal penalty. And qualified Roth withdrawals are generally tax-free.
Right.
Then, at age 73 and beyond, you're subject to required minimum distributions, which are also taxed as ordinary income from a traditional account.
With the big penalty if you miss them.
With that significant 25% penalty if you fail to take them on time.
And just to reiterate one last time, what's that penalty again for not taking your required minimum distributions on time?
It's a hefty 25% of the amount you should have withdrawn, although remember, it can be reduced to 10% if you correct the error within 2 years, but still, best avoided.
Definitely. All right, this has been a really comprehensive deep dive into the tax implications of Gold IRA distributions, and we've gained some valuable insights, especially thanks to the expertise from Doug Young. It's clear that understanding these rules isn't just about, staying compliant with the IRS.
Not at all.
It's a crucial part of strategically managing your retirement savings for long-term security.
Exactly. By understanding the differences between traditional and Roth Gold IRAs, the impact of age, and the type of distribution, and crucially, the potential for penalties, you can make much more informed decisions.
Right.
Decisions that will help you protect and maximize your retirement nest egg.
So, considering the long-term nature of retirement savings and the fact that, tax laws can and do change over time,
that's a key point.
how might having a well-rounded, diversified approach to your retirement accounts, one that could include but isn't solely reliant on, Gold IRAs offer the most resilient financial security as you look towards the future?
That's the big picture question.
It's definitely a crucial question to keep in mind as you plan for your retirement. Thanks for joining us for this deep dive.